We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Vermeulen, founder and chief market strategist of the Technical Traders. Chris, thanks for joining me today.
Hey, good to be back, Tom. Pleasure.
Always good to have you. And I think it's going to be a great review of a lot of the markets. Of course, we've seen a lot of volatility, somewhat unexpected moves in the markets since the election. And I'd like to sit down with you today to kind of talk about all of that. So let's start by kind of reviewing what happened from a technical trader standpoint in the markets around the elections and since. And if the reality of the fundamental debt situation and what mattered to the markets before the election is starting to kind of set back in now.
Yeah, I mean, I don't weave the election or economic data into too much of what I do, but overall, I think a lot of people are very bullish that Trump's getting in. I think it's kind of like a twofer. You get Elon Musk with the whole thing, focusing on efficiency and trying to cut some red tape, and so that naturally wants to help small cap businesses or small businesses, which is what really took off. I think the day after Trump won, the Russell 2000 jumped like 6% in one day, which is absolutely like pretty epic for a giant move in one index. So we are seeing the Russell continue to push higher, and I think that's the big benefit. Is it's going to benefit businesses in general, which is where money's been flowing into this market. Definitely, it's very selective where this money is going. I think before the election, there's a lot of nervous people. We've been seeing, we've got wars going on, talk of World War III. We've got people moving into defensive currencies or assets like gold, utilities. There's money's been flowing in a bunch of different areas because it's very nervous, and it's very indicative of kind of where we are, I think, in the overall economic and the stock market cycle, which, there's multiple stages in a stock market, plus there's cycles of when certain assets or sectors come to life. And all of these things are coming together, telling us that I think the end is near. The music is about to stop for the economy and the stock market, but I think we still have to let this Trump kind of bump kind of pay out. I think it's going to continue to move up. Seasonality wise, it's a very strong time of the year for equities and even gold. So I think, and it's favorable in the long-term cycle. So really, I think we're letting this news fully digest of who's going to be in. I think January, once Trump kind of gets in, that's when things, I think, January is a big year, a big month. Typically, however January month closes, if it's positive, it's usually a positive year for equities. If January closes negative, it's usually a negative year. So January is going to be very definitive of what's going on. I do feel like the music could stop in January, and meaning the stock market tops out and we start to see some chaos, but really need to kind of let things work itself out and see where we go from there.
So Chris, when you talk about that, the music stopping, what signs are you looking at that are pointing you towards that possibility?
Yeah, there's a few things. I can share my screen too and show some interesting charts here. If I show you kind of the stages, which there's some really important things to understand about the stock market and assets in general. All assets go through these 4 stages. This is based on Stan Weinstein's theory. Everyone loves a stage 2, which is a bull market. Nobody really likes a stage 3 topping phase, which is, I believe, where we are right now. And then a stage 4, which is a bear market, a financial crisis, whatever you want to call it. If you know how to take advantage of them, they are a huge opportunity. As an active trader and investor, we want a trend, either a big trend up or a big trend down. Either way, we can make money. The nice thing about a stage 4 is markets or assets in general fall about 4 to 7 times faster than they go up. So a lot of money can be made in a very short window. If the stage 3 comes to an end, which bringing back to your question of kind of what's going on in terms of the markets, if we look at the cycles in the market, there's 2 key cycles to look at that paint this picture to me that I think the music is coming to an end. And the first one is this blue cycle, which is the stock market cycle. Typically, when the stock market cycle is getting close to an end. The music is about to stop. We tend to see gold do very well. We tend to see energy stocks do very well in industrial capital goods. And all three of these have done exceptionally well. In fact, if we take a look at the chart, for example, of gold, and we'll focus on the monthly chart, we're finding some really interesting price actions here. And if we use technical analysis based around Fibonacci, which Fibonacci is in almost everything in life, plants, you name it, it's a very, very powerful tool. This to me is the most powerful tool for forecasting rallies and pullbacks. And if we were to go from the start of the last super cycle up to the 2011 market top for gold, and then back down to the low and carry that forward, it brings us right over into this level for gold, which is around that 2,750 level. Mm-hmm. I talked about this back in 2019 when we broke out of this base and we started this next super cycle. And so gold, to me, gold, silver, and miners have a lot of headwind. They've had the fun part is over. The stage 2 kind of rally for this phase, I think, is kind of done. I think we're going to have a lot of volatility here. But this scenario is very similar to what we saw back over here. This is back in 2006, 2007. We saw a multi-year pause in gold. This is when stocks took off, real estate. There were bubbles everywhere. And then out of nowhere, we saw gold just take off and scream to new all-time highs. And then we went into a financial crisis, the 2008 crash, where gold pulled back 34%. And what happens here is when we see gold to me is like the global barometer of what people are thinking. It's like planet Earth is like the hive and everyone has the hive mentality. When gold starts to rally like that and outperforms, we got to be aware there's a lot of fear in the market. And so we've had the same thing. We've had a multi-year pause. We got bubbles in everything, and gold has screamed to the upside to its measured move. And now we're seeing a big reversal. We're seeing sellers step in. And this is that warning sign that we're very close. I think the whole world is nervous, worried about currencies. They're worried about housing. They're worried about equity pricing, all of that stuff. Also, if we take a look at the energy space, like XLE, the energy sector stocks, we are seeing energy stocks trading up at levels where they typically have crashed. The 2008 crash, we had weak economic market conditions 2015, and again, even after that. And so we're up in this like resistance area for energy stocks. People are betting on energy doing very, very well. They're expecting oil to go to like $200 a barrel. They're positioning in these highly leveraged energy stocks. So if oil does take off, the stocks should go higher. And I think people are betting on World War III happening. And typically when gold goes up, it means they're nervous. People are betting on energy going up because they think war and there's going to be chaos. So they're moving into energy stocks. These are all kind of warning signs that I think we're in the late stages of a major stage 3 market top. And in capital industrial goods, when we take a look at these are, we just had a COVID bubble. Almost all factories think that they have this super strong business that's going to last forever. They've all been upgrading their equipment, their warehousing, their assembly lines. And so we have really good earnings. Typically when businesses start upgrading all of their capital goods equipment, it's usually right after a really strong winning streak, after an up cycle. And after something goes up, there's usually a down cycle. And so we're seeing good earnings in the industrial space, and it's been outperforming as well. So these three sectors have come to life very similar to what we've seen during major market tops, when the music's going to come to an end, as you said, or as I said, where stocks are going to fall. We're going to see bubbles kind of burst across the board. And so those are like the three things on the stock market side. Now, when we look at the economic side, which is this yellow cycle, economic data is always delayed. The stock markets, commodities move before the economy. You kind of need two bad GDPs to initially trigger, a recession. So there's always going to be at least a 6-month delay. But overall, we got bubbles everywhere. When we look at the housing, the cost to buy a house, it's way above the norm going back from 1973. It's super expensive. Housing's already started coming down. In most places, it's down 15 to 20% already. I think we're going to see the bottom fall out in the pressure in the real estate space. And we've got unemployment slowly working its way up. We've got business sales are struggling in the S&P 500. They're not really expanding in general. The multinational companies are struggling with a strong dollar. So there's a lot of those things. We've burnt through excess capital in the States. There's a graph the Fed shares about excess capital. We've burnt through all that from COVID. So now people are like burning through their cash. They're running out. And now we're seeing delinquencies in credit cards. We're seeing a big spike in delinquencies. We're seeing a spike in commercial real estate mortgages defaulting. And now we're getting into residential. So all of these things are very slow, big moving beasts that when the momentum actually, fully turns over, it's going to be a financial reset, a stage 4. It's not a bad thing if you see it coming and you're positioned and you're mentally prepared to hold on to certain things that you don't want to get rid of, but to know you can also benefit from it. So those are kind of the two aspects, the technical side, kind of a little bit of the fundamental economic side of things that I focus on.
So I wanted to pick up on something that you mentioned there, this nervousness within the market. How is that kind of manifesting itself, and where are you seeing that?
I think the nervousness really is really just kind of in the dollar. The US dollar typically does very well when we see kind of global fear in the market. If we take a look at what the US dollar is doing, when we look at the dollar, this is a daily chart with all the other currencies. The US dollar has been on a tear for several months. And even gold has been going up with the dollar. Not too often we have that strong of a dollar rally and gold screaming higher with it. So generally, when we look at the dollar, it rallies when we're in a bear market, in a financial crisis. It's still kind of the one currency that people kind of move to when they're worried. It's still a reserve currency. And so the dollar's doing really well. All the other currencies you can see there are in a landslide moving down. When we take a look at gold, gold has been moving up. And these are two things that tell me there's nervousness. People are scared of the market. They want to get out of these other currencies. They're worried. I think a lot of these other currencies and countries are very brittle. The US, you could say, is a total nightmare too. But I think other countries are much more brittle and could see more volatility. So people move to the dollar as a safe haven play. They cash out, they just move to the dollar to hold it. It's going up in value. So you naturally want to move your money. If you've got, money sitting in a currency, just sitting in cash, your savings or something, you might as well move it to a currency that's going up in value. And so that's why the dollar is doing well, because people are nervous. And gold is the same thing. People are moving into gold. And both of those to me tell me that people are nervous. And they're very conservative plays. The currencies move slow. So the dollar is a very slow moving beast. So you don't sweat bullets. It's not like a, gold miner that can move 5-10% overnight. And gold moves very slow. Very rarely do we see like 1.5%, 2% move in gold. We just did see a 3% move in gold, but that's because we're also coming to the end of a pretty major cycle. And usually there's big volatility at major tops and bottoms. But that's where I see the fear. These two assets, they're the slowest moving ones. And that's where scared money goes to. They want to go to something that's not volatile because they don't know what else to do. And they just want to try to make money, but they're not swinging for the fences.
Does that nervousness also manifest in how, let's say, the S&P and the sell and buy orders are acting in that, not necessarily the VIX?
I mean, I watch the volume flows on the New York Stock Exchange, and I watch the buy and sell orders there. And to me, the New York Stock Exchange is kind of like, it's the big board. So it's got all the big brand names. So when the average Joe, if you were to go up to anybody who might hold stocks or doesn't know anything about it, they're probably going to throw a stock name out. They're like, oh, I'd probably buy some of this. It's probably on the New York Stock Exchange. So I like to watch the volume flows there. It tells us when there's waves of panic selling. So what I look for is when a lot of people are dumping shares on the New York Stock Exchange. That to me is the general public selling whatever they bought because they're chasing trends and stuff in the media and news. They're dumping shares and just hitting the bid. They don't care what price they get out. They're just hitting the sell button. When there's panic on the New York Stock Exchange, it's usually a buy signal on for us, telling us, hey, there's actually that's them dumping their shares, and the market will probably go the opposite direction. So that's a very short-term indicator. But over the last several months, this year, actually, across the board, we've been seeing days where we have distribution selling, which is big institutions throughout the day unloading massive blocks of share multiple times through the intradays. And if you don't watch the intraday charts, you won't see it. But there's big money still unloading shares. You look at Buffett. I mean, he's loading up on cash. You go and look at the last times before the last two major market corrections, Buffett just kept loading up on cash. Like he's got a pretty sophisticated team. I mean, he's worth watching. And that's what we've been doing. We've been raising cash. We're still invested in the equities market, but we have a lot of it in cash right now because I think there's a lot more risk that downside than there is upside. So that's kind of how what I see going on here.
Mm-hmm. And going back to the dollar as well, Chris, it's strengthened as you pointed out over the last couple of months, especially since the election. But going forward, Trump wants a weaker dollar to support exports from the US. So how do you think he achieves that? And does that make you more vigilant on when he actually takes office?
Yeah, I don't know. I really don't know. I mean, I'm not sure how to manipulate currencies. I mean, he could drop the rates. Typically, if you lower the rates for a country, it'll lower the currency. People want to move to a currency that is generally moving up and that has a half decent rate of return. So if he does start slashing rates, that will probably help diminish the dollar. But people still flock to the dollar as a safe haven play. It doesn't mean it's actually going to go down. That's just the interest rate is just kind of one perk. In fact, if we look at the US dollar index, which is kind of a basket of currencies, I think we're going to go back to what we've seen in the past, which if we take a look at the dollar index here, during the tech bubble, we saw the US dollar take off. It had a big screaming rally. It was leading up into the crisis, and it moved dramatically higher. In 2008, we saw the dollar index scream higher as well as a defensive play. It popped short term during COVID, but typically whenever there's weakness, we had financial weakness in 2015. It moved up very dramatically. We had it after COVID. It's moved up. In general, when I look at this, I see higher lows. I see higher highs. I see a series of pause, rally, pause, rally, pause. I think we're going to see the dollar index go higher, which means it's stronger against other currencies as well. I think the dollar is going to keep moving up. Mm-hmm. So I don't know. I mean, I don't know how Trump will do it or what they'll do, but I don't think it's that easy to manipulate currencies. I'm sure they can in some way, but to me, the underlying trend, you can't really fight what the market is doing. You might be able to delay or mute things for a little while, but generally, the cycles will come into play and take over. So I'm expecting the dollar index to go up, expecting the US dollar itself to go up. And we'll probably see like the Canadian, the loonie fall with oil. So I'm not sure how he'll do that or what he'll do, but definitely a high dollar hurts the multinational companies. I mean, you can see this right here. There's a few things playing into like the NASDAQ, the semiconductors right here. When we take a look at, I'm just going to go back to the daily chart of the NASDAQ. The NASDAQ's really struggling to get some traction. We had a big pullback in July and August, and it really just broke to new all-time highs, and it is really struggling to get legs to push and go higher. Where if we look at the S&P 500 for the same time frame, the S&P 500 broke out a long time ago, and it's moving higher. And I think a lot of this has to do with a couple of things. The high dollar is definitely making it harder for multinational companies to sell their services to other countries because the currency is so expensive to these other countries. The other big thing I think is Trump talking about the tariffs about semiconductors, which is why I think we're seeing the AI space struggle. We're seeing semiconductor space struggle, and that's holding the NASDAQ down. So those are a couple of key things I think to realize. And I think we've seen the mega techs, the Magnificent Seven, do most of the heavyweight lifting over the last several months, or really the last year and change. Now I think they're actually kind of done for a little bit. And now we're starting to see money move into broad market stuff and like the Dow and the small caps. People are kind of getting away from the big techs.
Yeah, it's interesting to try to think about, to kind of conceptualize the scales, if you will, on either side of what could play out for the dollar, right? On one hand, you can see demand for US dollars really driving it higher. And in a crash type scenario, people are going to run to the dollar. You see that all the time. So that creates, this push for moving the dollar higher. Mm-hmm. And on the other side of it, if we do get, a general crash like that, obviously, rates are going to be slashed, or typically rates get slashed, and printing goes up to save whoever needs to be saved. So, trying to think about how that ends up balancing out is, I think, always a real challenge.
It is. It is for sure. And typically you'll start to see the Fed and the rates get slashed as we go into a recession, as the economy weakens, stock market falls, when the elite people start losing a ton of money because the stock market's crashing and all that stuff, right? Then they start slashing rates to say, hey, how can we slow this is the way I see it. If we cut rates, we can slow the stock market bleed out so the wealthy don't lose all their money.
Yeah.
And then after all that slashing is done, eventually the dollar, the economy will strengthen, money will come out of the US dollar and people will bring it back to their own currencies, invest in the stock market. And also because the dollar now may have a lower interest rate as well, because they've just slashed it all. There'll be a delay, right? But that's how the whole cycle, that's how I see it unfolding, is pretty much as you were just mentioning there.
So again, revisiting this idea that you brought up in kind of the first big explanation there, Chris. If you're bearish on gold, you're likely bearish on the general equities and even energy. Where are you bullish?
Yeah, I mean, we're still long the equities market. You don't want to fight the trend. I mean, we're clearly still in I don't want to say a bull market. We're in an uptrend. It's very sector driven. The majority of most stocks are not near all-time highs. It's just the Dow, the NASDAQ, the S&P 500, they're kind of dragging up with the big, with energy stocks and also with the Magnificent Seven. So it camouflages what's going on. The reality is, if you equal weighted the stock market, look at the small caps and the micro caps, stock market is kind of still struggling. It's not as strong as people think. So we're in this stage 3 topping phase. And my point is, you need to be long the trend. If the trend is up, especially on the long term and the short term, you need to ride this higher, which is what we're doing right now. Eventually, we're going to see, I think, the market roll over. We'll probably see rates starting to get slashed. I think bonds like TLT, the long-term treasury bond ETF, will become a very good play. Now, it's still trying to find a bottom. It's not there yet. I think that'll be an opportunity. I do think the dollar ETF, being long the dollar, will be good. And eventually, when we get into a stage 4, when the markets pull back a lot and we crack to the downside and start an official bear market, that's when we'll move to actually an inverse ETF. So as the stock market falls, we'll end up, benefiting from the falling pricing. The ETF goes up. So that'll be the play. So until we get to a stage 4, we'll probably be either in bonds, the dollar, or cash, just earning interest during some of that volatility. And then once we kick into a stage 4, then we're like, okay, now let's profit. The market's going down in general. It's constant shares are selling. Let's benefit from that tide going down.
Obviously, Bitcoin, generated a lot of volume and a lot of hype around the election as well. So we didn't end up breaking that 100K ceiling or let's say resistance. Are those round numbers typically difficult to break through? And what are you seeing from the Bitcoin chart?
Yeah, it's funny. I'm not a crypto or a Bitcoin person, but for the first time, I bought Bitcoin 10 plus years ago, and I haven't touched it since. I just leave it. I don't even know how to buy a crypto. I mean, I get the theory, but I haven't bought a crypto in so long. So anyways, taking a look at Bitcoin, I mentioned this to subscribers 2 weeks ago. I said, listen, it's the first time I've been excited about Bitcoin. I'm buying some. And so I shared my trade alert. And this here is the monthly chart of Bitcoin. And what I like about this is using Fibonacci extensions. This tells us the momentum of this rally and this bull flag pattern, and tells us where we should see Bitcoin move to. First one is around 86,000, and then the next one's up to about 109,000 per Bitcoin. And so we played the move up here from here. We've locked in some partial profits. I like Bitcoin. I actually think it's going to 110. But as you said, Tom, the 100,000 mark is a very critical level. When we zoom in on this on the daily chart, 100,000 is a whole number. And typically there's going to be a ton of people that say, hey, if Bitcoin hits 100,000, I'm selling my position, or I'm going to take some partial profits. I'm going to sell a little bit and probably move my stop up just because these whole numbers are very significant. And so we tagged it, and now we saw a bout of selling, and that is to be expected. I was letting everyone know if we hit it, there's going to be some triggers, some sell orders getting hit, and it's going to pull the market back temporarily. I think it's nothing more than a technical test, because I think we're actually going up to about 110, 112, 113,000 for Bitcoin as the next full measured move to the upside. So I like Bitcoin. I think it's trying to stabilize. It might still want to pull back a little bit deeper down to this 87 area, which is the 20-day moving average. It's also a Fibonacci retracement that typically, if price pulls back 38% of whatever it rallied, that is usually a sweet spot. So that also coincides with the 20-day and in that level on the chart. So I like Bitcoin here. I think it has more upside, and the monthly chart is very powerful. And I think it's got lots of momentum, and that's why I trade it. It's a very herd mentality momentum. I mean, we can see here, just the last trading session generated a buy signal, an oversold buy signal. It's popped up like 4.5%, 5% today, just on a momentum basis. So Bitcoin is tracking and trading very, very well based on intraday chart patterns of oversold, overbought conditions. It's also tracking and moving exactly like it should for on the daily and the monthly chart. And that means there's very strong chance it's going to go hit that 100% measured move. This orange line here is that Fibonacci level I talked about. And generally, if you come up to this level and there's a pause, you almost always go up to the 100% measured move, which is this green line up here around 109, 110. So this is exactly what we want to see, is this pause at this level. This is where we took our first partial profits. The rest will be moving out when we get to this 100% measured move mark. So you got to be bullish on it here. It's long-term charts are super strong.
And of course, that's, as you said, it's not necessarily that it's a particular, let's say, belief in Bitcoin, but taking that emotion out of it and looking at just the technical nature of the chart, that's what gets you excited about it.
Yeah, it's a pure technical play. There's just so much momentum, and I follow Bitcoin. I don't follow it super closely, but I know it is like a herd mentality trade. So everyone buys into it, kids and adults and grandparents, and it gets headline news right away. So it's like, hey, if you got the perfect chart pattern and it's pointing to higher pricing, I might as well milk it for the surge of everyone piling in. Now, I am not a crypto guy. It's not saying I don't really put much value in it. It's not my space. My specialty is understanding the flow and the cycles within the stock market, bonds, currency. That is kind of my bubble. That's where I focus. And Bitcoin is nothing more than a speculative trade, to pull anywhere from, 15 to about 49%. If we can hit this measured move, it'd be about a 49% move to the upside. So it's just a trade for me, not a long-term investment. And just because it hits that target, if it gets up to that 100% measured move, I know the way people think, they're like, well, I don't want to sell it. It's doing really well. To me, I'm like, that's where you get out, because that's where a big bout of selling could actually kick in.
Mm-hmm. So, Chris, let's go to the gold chart, if you don't mind. You explained to us from, let's say, the cyclical point of view about, why you're not necessarily super bullish on gold at this point. But how is that being reinforced in the charts, and what is sentiment also telling you?
Yeah, so when we look at gold, there's no doubt gold has hit a major resistance level, which is this green line. This is going back like, the 15-year cycle previous. It's hit this level, and now we're getting into volatility. We're seeing some high volume selling. It doesn't mean gold is fully topped. It could still continue and grind higher. It's just the projected move is done. It's done it in a very clean way. It's at a series of rallies and pauses and rallies and pauses, a bunch of small bull flags and bigger bull flags. It has made it here. Gold is still in an uptrend. I'm not saying short it. I'm not saying it's going down right away. I'm just saying the measured move is done. Now it's like, how is it going to deal with this? Maybe gold is actually just going to consolidate and build a little bit of a launch pad, just like it did over here. It builds a bull flag. It rallies, builds a bull flag, has the second half of the move. A bull flag is the halfway point before the next target. And so this could be the bull flag hole. This would be the flag. And we might see it want to head up to around 3,000. So you don't want to short it by any means. It's in an uptrend. People can continue to hold it. It's just the the measured move is now done. And to me, what signifies that is we've seen a lot of volatility in this market and in gold selling off. So this is definitely a critical level that institutions and other money has been kind of also been following, and they're moving out of this space. So I'm not bearish. I don't see, it skyrocketing and taking off as the new major leg higher. I think we're going to go eventually into a bigger correction, potentially back down to about 2,100 after a financial reset, hopefully next year. And then from there, that'll be like the opportunity to get into gold, silver. This is where miners will come to life. This will be like the next major miner run. They're far from performing well, which tells us gold's probably not going to the moon right now. So I think, a year from now, or whenever the markets have this correction and resetting, I think miners are going to be one of those opportunities that if you've ever caught one, I mean, they're life changing. The returns on mining stocks after they've been beat up are phenomenal. So that's what I'm hoping for. I'd love to see the markets correct and reset. We're going to see real estate reset. We're going to see all kinds of stuff reset. It's an opportunity to, avoid the correction, knowing there's one coming and being able to identify it, but then to reinvest into these companies and these commodities when the time is right. And that's the key, is people fall in love with something and they listen to only people who think and believe in the same thing. But the reality is sometimes you got to step back and look at the charts. Like, I'm a gold bull bug. I mean, I've got 1,000-ounce silver bar behind me. I love precious metals, but reality is I'm expecting it to pull back. I'm not going to sweat bullets. It's going to be an opportunity to buy more. I like physical gold as a long-term investment. I don't buy it to swing for the fences for big returns. But when the cycle comes around for miners, that's when you can start to, nibble on some miners and hit some grand slams.
Chris, you kind of mentioned this idea of looking at oversold and overbought conditions with Bitcoin. Can you show us in the gold chart or another example of how you see those levels and how they end up informing, let's say, your short-term to medium-term thinking there?
Yeah. So this is the way I look at it. So this, maybe I'll just get rid of that green spike up top. So this here is the 30-minute chart of gold. This is regular trading hours only. So 9:30 Eastern time to 4 o'clock. That's when the majority of the volume trades. That's what I follow. These top two indicators are green when it spikes up is panic selling on the New York Stock Exchange. When we have spikes in the red above the blue line, that's usually FOMO, people buying and they just don't care what price. They're like, just get me in, get me in. Those actually don't really play too much into gold itself. So I'll just kind of get rid of those. But the key here with the oversold conditions, and the market has an oversold condition, meaning it's rallied up, it's pulled back. Usually you get these lime green areas. And if it coincides with this pink line, which is the 20-day moving average overlaid on the 30-minute chart, I love the 20-day moving average. Generally, this is a signal where the market has rejuvenated. People have panicked out of gold. They've dumped their shares. And based on a bunch of different calculations that I have, it's saying, hey, the general masses have now just had their stops run. They're spooked out of it, and we should see it go higher. And so we get this over and over again. You can see in gold, not only that, but there's a series of bull flags. Bull flags are very bullish. Eventually, there will be a trend change. Eventually, one of them will fail. And that's what we've seen here recently. Gold had a big pullback. Now it's into red bars. Into red bars. And red bars are generally meaning on a short-term basis, we're in a downtrend. And when we have these red shaded areas, this is telling us gold is actually it's overbought, and we should start to see it pull back, which it's starting to pull back now. So these are very powerful short-term signals to be able to load up and trim profits and be kind of aggressive in the short-term basis. But gold right now is in a short-term downtrend. Trying to figure out if this is just going to be a sideways pause, a consolidation before potentially going higher. I do think gold will want to go back up potentially and test the highs around 2,800. I think gold will become that defensive play again as soon as stocks start to show some weakness, and the Russell 2000 starts to sell off a little bit more, which are the small caps in the States. Typically, money is going to come out of those riskier stocks, and they're going to go somewhere defensive. Could be the dollar and gold. See them both move up. So this is a time where gold can move up in the opposite direction of stocks. when people get nervous still. So gold's not dead. It's just in a short-term downtrend. Time to kind of ignore it for now.
Mm-hmm. So is silver showing much of the same kind of action?
I use gold as my main barometer. Silver is naturally a super ugly chart, really volatile, lots of mixed signals. Silver, you can see here, has red bars. It's turned into a downtrend. So it's anticipating lower pricing, and it looks like it wants to break down. I mean, the daily chart actually shows a pretty good, pretty bearish looking pattern here. That if this breaks down, I think we'll be going right back down to 28 for silver very quickly. So. Typically, if gold's in favor, silver should be in favor. Same with miners, but not always. I like to follow gold. To me, it's the cleanest moving barometer of what precious metals, the underlying trend should be doing. Is the tide going up or going down? And then when you've got a really clear signal in gold, then I'll go and I look at silver and I'll look at miners to try and time entries. But silver is it's really volatile. I used to trade it, and really now my focus is just get in on gold, trade gold because it's super clean. And then when I really like the precious metal space, then I'll get into some silver or get into miners and leverage that. But right now, silver's not the greatest looking chart pattern.
Mm-hmm. So, Chris, are you expecting, something like a 2008 financial crash? You said you're kind of waiting for that financial reset of sorts to really get back into the miners, perhaps.
Mm-hmm. I am. Yeah. I mean, that would be ideal. Everything seems like I was in Las Vegas recently with about 36 very savvy investors who have entrepreneurs of big businesses, and they've all said the same thing. They all have a similar problem. They have tons of money. They will where can we put our money? Where can we invest? Because they're worried. Real estate is overvalued. Stocks feel overvalued. They see things coming to a grind. Their businesses have slowed right down. They're like, money has dried up. The end user, their wallets are not open like they used to. They're like, it has completely changed. Mm-hmm. So that's the big question: is where do people put their money, right? And there really isn't anywhere to go. I mean, other than play the stock market because it's going up. Mm-hmm. I own U.S. equities for two reasons. First of all, the U.S. dollar, I believe, has been going up, and I believe is going to continue to go up. So I want to hold U.S. dollars because just holding it alone, I should benefit from an increase because I'm in Canada. So I want to get that currency growth. And on top of it, equities are still in a strong uptrend, and I want to ride equities higher. And so those are kind of the plays I think to be right now. And there really isn't anywhere to go other than that, in my opinion. Anything other than that carries a lot more risk. And it's tough. I mean, there's a lot of cash on the sidelines because people, there's a lot of people arguing, saying there's so much cash on the sidelines. When it comes in, it's going to drive the stock market huge. So I'm like, well, I think there's a ton of cash on the sidelines. That could happen, but I believe they're savvy enough that they're like, no, I've taken it out because everything is too expensive and I'm waiting for a reset. And I think we're going to see that reset happen before that money wants to get deployed again. I don't see Buffett piling in up here with all of his money. We're going to need some type of reset in the system. So,
well, and to that point, is there more money on the sidelines, or if we get the cracking of this everything bubble, as you're saying, in stocks, in real estate, in so many of these different areas, does that end up being so much of a larger domino that scares the crap out of everybody to reinvest, and the capital destruction that comes along with that? Like, is that next crash, does that do so much damage to the markets that we don't see it really rebound in any real sector? Is that a possibility?
It's a possibility. Like, I mean, the markets, people are so used to buy any dip and it rips higher. Just give it a bit of time, right? We could go, I believe a lot of things are unfolding very similar to the 2000 tech bubble. And it has a little part to play. Like, yes, technology has been a huge driving force of what's going on, but there's other cycles for commodities being the most undervalued compared to other assets right now. And all the dollar, a whole bunch of different things coming to play. I think we could actually have a multi-year bear market where it may not just go into a waterfall sell-off and collapse and crash. It could drag out like 2 or 3 years, like after the tech bubble. Things could unwind, and then it could take years to recover because people are so nervous. As you just said, they got so scared. They're like, I can't do it. I can't do that again. Right. Like people are still very scarred from the 2008 crisis. People are actually pretty scarred from the 2022 pullback where bonds and stocks fell together. And like, I mean, it was a disaster for anybody who held bonds and equities. Man, you just got annihilated. So it could be a very slow comeback in terms of the market. And that's the nice thing about what I do, which is 100% technical driven, follow the price, manage our risk in positions, is we don't really care. If this market keeps going up, well, eventually there'll be a pullback and a reset that it reinvests us right back in our full portfolio. If the market rolls over, we've got strategies. So that's the nice thing, is it doesn't matter what happens. Doesn't matter how long something drags out. We don't have to guess and just pick a side. And that's what most people do. They're going on gut. They're going on politicians and all this stuff. And they're just really picking something. You know, technical analysis and risk management is not about trying to pick a direction. It's about identifying a trend that has strong enough internals saying, hey, there's momentum behind this. And then once that trend is identified, we hop on and ride that trend. So we're never in at the bottom because we need it to rally and show strength. We never get out near the top. It's got to pull back and do quite a bit of damage before we're like, okay, it's now technically in a downtrend. Let's get out. So we're always just going for that middle section, right? We get in late, it rallies, it pulls back, we get out late. That's just the reality of managing risk. Is you just have to deal with it, right? But so that's the nice thing, is it doesn't matter. People don't want to hear this. They're like, oh, I want to know where it's going. I'm like, it doesn't matter because you don't know. Nobody knows. So you might as well just follow it. Build a strategy that allows you to follow something very efficiently.
Yeah, I think you just hit the nail on the head. Build a strategy that allows you to follow something regardless of what market it is. If it has usefulness, and you know, if you can replicate it, then that's where the value of that strategy really comes in, regardless of if you love that market and you believe in that market or not. You know, I know many of our listeners hate Bitcoin and love the precious metals no matter what. And there are so many cross currents and cross narratives and different weights on the scale on both sides of any of these markets that we've touched on today. It is hard, and I think harder than ever to really figure out where any of these markets are really going. And the ability to have a strategy in place that gets you that fat middle part, I think is the key to getting the most out of these markets.
Yeah. And I mean, you brought up a good point. So if we were to break the market into these 4 stages, right? There's early bull market, there's all these stages. The reality is you need a different strategy for generally different stages. So there's going to be times when, you know, certain strategies will perform. You might want to trade the hottest sectors during a bullish phase. You might want to, anyway, there's option strategies. There's all kinds of different strategies. People don't get this, Tom. They use the same strategy. They buy breakouts. They buy stuff they like when the market is in any market condition. And they don't realize you actually have to change your strategy. And that's what I do with my newsletter, is I share my strategy, which I trade my own capital, and I just share the trades I do. So I ride the coattails of the market, and subscribers ride my coattails. And I automatically adjust the strategies. I adjust and move with the markets. And if you don't change your strategy, there's a very different strategy that performs well in a stage 3 than there is in a bull market. In a bull market phase, a stage 2, you want to get into sectors, you want to get into more explosive stuff. But when it's sector driven and one sector is hot for 1 week and then it falls off the radar the next, like we've been in since pretty much March of 2021, sectors have been all over the place. You need a different strategy. And when we go into a stage 4, a decline, you need a different strategy. And that strategy is so different. People don't know how to trade a bear market. They're very rare. They're not difficult. In fact, it's really swift and super rewarding because usually trades only last like 5 to 10 days and you make a killing and you're out. They're very explosive. You hit your targets, you're done, wait for a reset. But you have to understand that different market conditions require different strategies, different mindset. You're playing on a very different emotion because everything's flipped upside down and backwards. And you're always going to be fighting the trend of herd mentality as well.
Right. Chris, I wanted to before we wrap up here, visit the oil chart if we could, and ask if there's any clear trends in that chart. Are we going to $200 oil and inflation, therefore kind of explodes, or how do you see that picture kind of developing?
Yeah. So if we take a look at crude, and this is the daily chart, it's not a very bullish chart. In general, the most recent price action is the market breaks down, and then it more or less kind of finds a little bit of a support level. It kind of pops and fades, and then it breaks down. It's got a support level. It's popped and faded. So it is stair-stepping its way down. To me, it's very close to a much larger breakdown. So if we look at the monthly chart, which really kind of cleans things up, we can see the overall price action. Let me just get rid of that zero negative spike in there. If we look at crude and where it is in the grand scheme of things, say we just kind of skim these tops and skim these lows, we're pretty much right in the middle of the range of where it is. So it's in no man's land, drifting sideways. To me, this is more of a bearish chart pattern, simply because it has had a move up and a pullback, but to me, I think this has been more so a sell-off, and it is kind of flagging here, really struggling. I think it is on the verge of having a big leg down. I think we could go down into the 50s, potentially even into the 40s over the next several months. I think it could have a big landslide and wash out. Now, totally different depending what happens with Russia and World War III, all that stuff. That could send gold and oil through the roof. Those are black swans. Those are things no one really can predict. Mm-hmm. The chart here, to me, based on the stock market cycle and commodities and assets that are performing, the economic data that's been rolling out, and this current chart pattern for oil, to me, is pointing to lower pricing. And I think we're going to see much lower oil come next year from this chart. But again, the war is going to be a wild card. It could send oil through the roof. I do also think, Trump's talking about a lot of oil in the U.S. That could also be a big part of this, like saying, hey, let's not just get it from the other side. Let's just produce it ourselves. We're sitting on huge reserves. So that could also be unwinding the oil price, going, hey, we got a lot here that we actually can control and get at. So I'm kind of bearish on the energy space, which I find funny because the energy stocks are like priced to the moon, like oil is going to go, skyrocket here. So if oil breaks down, I would expect that chart of XLE, the energy sector stocks, it has a chart pattern that is very volatile. Either energy stocks are going to skyrocket, or they're going to come straight down with multiple red bars and crash. And so if oil breaks down, I do believe the energy sector space will be one heck of a short trade, or there's probably even an inverse ETF for it to benefit from that. So the energy space to me is bearish in my point of view.
Mm-hmm. So again, just kind of have to wait and see where that clear trend develops, right?
Yeah, and I mean, nobody likes to hear that. You got to wait and see. It sucks because everybody wants answers, right? But that's not how. If you want to manage risk, I can give people answers, but it's a real crapshoot. You're much better to follow it. So the key here is to understand the underlying trend, expect lower pricing for oil. It looks like it's already starting to break down. Mm-hmm. I think energy stocks will sell off percentage-wise, huge. And really, if oil starts to break down, if oil starts to break this, there's a little wick here. It's hard to see, but if oil starts to break this low, somewhere around 63 and close below there, and energy stocks start to break down from their chart pattern. Let's just pull up XLE. If energy stocks start to break this kind of support trend line through here, that could be one heck of a big unwinding in energy space in the energy sector coming down. Now, this chart pattern here, as I mentioned before, is very, very explosive. This is kind of like I live on the water, and there's a little island just out where everybody swims to, and somebody put a flag and flagpole on it. And so my daughter and I always watch these storms. When we see the front come over the mountain, you see that dark black, greeny or blue line of clouds. We sit out there and we watch the front hit, and the flag will be like flagging down, the calm before the storm. And then suddenly it flags up and it's just flapping. And when the flag is flapping up like this here, so if I was to just clear this, it means extreme volatility. So here we have the flagpole. typically a flag will flag down against the trend. The trend previously is up and it flags down. That is a nice controlled trend. When it flags up, there is tons of power and there's going to be huge volatility. So this could explode to the upside if there's World War III. And if not, if it starts to break this low, there's all these other lows layered under here. There's going to be all kinds of these. Every time there's a wick low, there's people with stop orders in place. And once you start to trigger one, it can send trigger orders that create that momentum, and it just keeps triggering more and more, and it just creates this massive landslide. I think there's great opportunity in the energy space. I think the opportunities to the downside, I'm more excited about that than I am of a breakout rally to the upside.
Mm-hmm. At this point, because of the chart.
At this point, because of the charts. Eventually, energy stocks will be a screaming buy, amazing dividend paying. As you know, everything goes in and out of favor, right? Right now, I think they're like nosebleed, high risk. I think come after the recession. One of the best ETFs I ever bought was in Canada. It was a utility and energy ETF. It paid 16% dividend at the beginning of 2009. And I bought it and I held it for a year. It doubled in price, plus it paid 16% dividend. And it was all based around like energy stocks. So, they'll have their time to shine. Right now, they're at near all-time highs. I feel like they've shined. They're shining. But I think that based on things, I think there's going to be a bit of a reset.
Mm-hmm. Yeah, I always feel like we have to give that caveat of kind of what that timing is and why that is. It's not that you're necessarily bearish on energy for the long term. There's very specific reasons and timeframes that you feel that way.
Right. Yeah.
Excellent, Chris. Well, as we wrap up here, do you want to leave our listeners with something to think about?
Yeah, I think people just need to understand 2025, I think, is going to be a very, very volatile year. I think you need to focus on preserving your capital. Don't get sucked into trying to make a ton of money in 2025. I think it's actually going to be more like preserve your capital preservation. Find a way to understand when the market has changed direction, like when the top has been put in or whatever commodities or whatever it is you follow. Make sure you know when you should be probably stepping aside. You can always re-enter into a trade. People just don't want to get rid of stuff that's been working. Mm-hmm. And a lot of stuff has been working. And so people will hold on to it until it turns into a loser. And that's not, how we really want to do it. So I think find a way to identify, follow trends, figure out how you're going to navigate whatever assets they are that you hold, and figure out a way to track when they're changing direction so that you can protect your capital and reinvest in it later when it's re-energized and ready for another big run.
Mm-hmm. Excellent, Chris. Well said. Of course, for anybody that wants to follow you or get more of that information or your newsletter, that's all available at thetechnicaltraders.com and also on Twitter. Excellent Twitter follow at the Tech Traders. Chris, thanks so much for your time today.
Thanks, Tom. Pleasure. Anytime.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.